Hello and welcome back to Feynman Education. In today's video, we're delving into the world of finance and economics, all while exploring the 2008 economic crisis through the movie The Big Short. Get ready to understand the reasons behind the crisis and key economic terms in a relatable and engaging way. Whether you're a high school student interested in economics or simply curious about the impact of financial events, this video is for you. Before we dive into economic crisis, let's take a brief look at the movie The Big Short. Released in 2015, the film is based on a true story and follows a group of investors who foresaw the 2008 financial crisis. These investors recognized the impending collapse of the housing market and made bold moves to profit from the crisis. The 2008 economic crisis was a global financial catastrophe that began in the United States, impacting economics all around the world. It was triggered by the bursting of the housing bubble, where home prices rapidly declined, leading to mortgage defaults and financial instability. Imagine you live in a neighborhood where house prices are steadily increasing year after year. This rise in prices might seem like a great thing at first, like a magical money-making scheme, but let's explore how this phenomenon works, knowing as the housing bubble works and why it eventually bursts. The housing bubble is a situation in the real estate market where home prices increase rapidly, driven by factors like speculation, excess demand, and easy-to-access credit, just as we learned in our economics class. When the bubble forms, people start seeing homes as a surefire investment that will continue to grow in value, just like a magical balloon that keeps expanding. As more people rush to buy houses, demand surges, and sellers take advantage of the situation by raising their prices. With high demand and rising prices, lenders become more willing to offer loans to potential home buyers, including those who may not even have a strong financial background. This increased lending is often driven by the belief that housing prices will keep rising, making it a safe bet for the lenders. The cycle continues, and soon the housing market becomes overinflated, much like a balloon stretched to its limit. But like all bubbles, this can't go on forever. Eventually, the bubble becomes too big and reaches a point where housing prices are no longer sustainable. Just like a balloon that's too full, it pops. When the housing bubble bursts, home prices start to plummet rapidly, leaving many homeowners with properties less than their mortgages. Suddenly, those who took out loans during the bubble find themselves unable to afford their mortgage payments, leading to a surge in mortgage defaults. This is where subprime mortgages come into the picture. These mortgages are loans given to the people with low credit scores or inadequate financial histories. These borrowers are considered riskier because there's a higher chance that they may default on their loans. During the housing bubbles, lenders were eager to lend money to even riskier borrowers, believing that the continuously rising home prices would protect them from the losses. These subprime mortgages were often bundled together with other mortgages and sold to investors as mortgage-backed securities, like pieces of the balloon that were sold to different people. The problem arose when the housing bubble burst and many subprime borrowers were unable to keep up with their mortgage payments. As a result, these mortgage-backed securities lost their value, causing significant losses for investors and financial institutions. Credit default swaps are financial instruments that act as insurance against potential loan defaults. It's like buying insurance to protect yourself in case something bad happens. In the movie The Big Short, we see how some investors like Michael Burry use credit default swaps to bet against the housing market, anticipating the collapse and making huge profits. The 2008 economic crisis had a domino effect. When housing prices collapsed, it had ripple effects throughout the financial system. Major banks faced severe losses, leading to a credit crunch and a recession. Just like falling dominoes, the crisis spread from one sector to another, impacting businesses, jobs, and even people's lives. The 2008 economic crisis taught us several valuable lessons. One of the most significant takeaways is the importance of responsible lending and borrowing. Lenders need to assess borrowers' ability to repay loans, and borrowers must be cautious about taking on debts they can't manage. As we wrap up, The Big Short gives us a glimpse into the complexities of the 2008 economic crisis and factors that led to its occurrence. Understanding these key economic terms and learning from the historical events can help us make financial decisions and contribute to a more stable and sustainable economy. Thank you for joining us today on Feynman Education, and don't forget to subscribe and hit the notification bell to stay updated on our future videos. Until next time.